Well, as I often like to do before we start these panels, getting a survey of the room, if by a show of hands, if anyone could raise their hands on who in the room has invested in Bitcoin mining companies in any way. And if you could keep your hands up if you've invested in public markets only, or okay, and who's invested privately in mining or directly in mining. Okay, great. Super. Well, so we have a quite sophisticated audience for the subject, so we can definitely keep it not too high level and dive straight in. So, as I discussed in my opener today, and as we've discussed throughout, we've been coming out of a risk-off deleveraging cycle. We think that the deleveraging is behind us. We saw that this posed particular challenges for miners, but as was discussed yesterday, we were talking about China, the concept of Weiji, which is the philosophy that risk and opportunity are interlinked and come out of crises. And some miners have been adept at navigating these challenges quite well, whereas others have not done as well. And fortunately, I share the stage with people who have been very successful in navigating this space and this time quite well. So I wanted to start with Jaime. Hut 8 has been able to look through the cycles, was one of the first miners, if not the first, to have a public listing. I think first or second.
We were second after Frank.
Second after Frank. So you've seen quite a few cycles. You've been able to navigate them quite well. I'd love to, first take a look backwards on, what you think have been successful strategies and unsuccessful strategies in the last cycle, and then we'll dial it forward and look at what you think are the good opportunities now. Again, looking at whether you're doing mergers and acquisitions, focusing on organic growth, combination thereof, and how that kind of changes through the cycle.
I see you haven't improved on your compound questioning skills. And I'm getting older, Zach, so my memory's not as good. I'll kind of tackle where you started, and then we can go wherever you want. I think one of the interesting things about having been a public miner through two bear markets, two bull markets, if you think about how the public market space for miners evolved, it really started in Canada. So Hive was the first, Hut 8 was the second, Bitfarms was the third. And so we, as a collective, weathered, with a number of other participants, weathered the last bear market. And one of the things that really differentiated those of us that survived was a diversified strategy in many cases, a strong conservative balance sheet management in the majority of the other cases. And when we think about who really blew up in this past bear market, it was none of the old timers. The old timers kind of applied the same strategy and were able to navigate well and in many cases thrive. And I think those lessons learned are incredibly valuable. Those that we saw blow up, it was very much about taking on too much leverage and then not being able to weather the downturn. Obviously, the combination for miners of an energy crisis, energy is our largest operating cost, so a lot of people had exposure from an energy perspective, and then combined that with Bitcoin pricing that really deteriorated quite quickly, and then a hash rate that just will not quit growing. It was absolutely the perfect storm. So at Hut, one of the things we did in the last bull market was really focused on cleaning up the balance sheet and looking at building out a diversified business model. So we were the first miner to do, in the bull market, we did an M&A transaction where we actually purchased a high-performance computing data center business, so uncorrelated to Bitcoin, and really started focusing on a strategy that brought us fiat-based income streams to help diversify our cash flows and protect some of the downside, while at the same time maintaining our HODL strategy. So our balance sheet, we have the most amount of self-mined Bitcoin on balance sheet of any company. We're the first to hold Bitcoin on balance sheet. I know Michael Saylor's made it famous, but we're really the OGs of it. And so that balance sheet first approach, that conservative approach, very, very little leverage, combined with an increasingly diversified strategy, I think has been one that certainly fared well for us and many of the other miners in the space.
So one of the trends that we saw occur during the last cycle was a pretty significant institutionalization of the space. As these public miners started to gain very significant market caps, started to become parts of the portfolios of large institutional investors, it started getting some institutional understanding. You started seeing analyst coverage of the space. You started seeing buy-side institutions looking to understand the space, looking to allocate capital, both through the private and public markets. Pierre, we had actually I've had the pleasure of working in professional capacity with everyone on this stage in some way or another, and can only speak highly of my three colleagues here in that regard. But Pierre, we had the pleasure of working together with a sovereign institution that looked at the space and decided to allocate capital through a variety of channels. Would love to understand your perspective when you work with, advise institutional investors, how they're looking at the space, whether they're coming at it purely as cash investors, whether these are institutions that come with some power capacity. And I won't compound my question any further for your benefit.
You can't help it.
Well, thanks. No, I think maybe to answer the first point, what we see is a lot of institutional education that happened over the past 2-3 years on the topic, which means that more and more, and our clients are usually sovereign funds or like blue chip companies, more and more there is an interest in exploring the benefits of Bitcoin mining in adjunction to their existing operations and in adjunction to their existing portfolio. So it's not purely seen as kind of a cash investment, it's really more and more seen as a strategic investment. And in particular, I mean, no surprise, the energy industry is one of the main institutional drivers of this. So we see a lot of discussions going on with energy companies that want to understand how they can utilize Bitcoin mining to make their renewable energy assets way more attractive, because they're gonna increase the utilization of this. While at the same time, depending on in which power market you operate, use it as a measure of demand-side management where you can ramp up and down the power consumption relatively quickly. So I would say the institutional sophistication has grown way bigger. There is still obviously a bit of reservation towards the industry, but I think, this is now, I mean, for me it's the second winter, for most of you probably it's the third one or the fourth one. All of these winters always help to kind of professionalize the industry, and I think this was, in that respect, a very healthy movement that we saw now.
So for those of you who know me, you may know that as long as I've been covering the sector, I've been trying to encourage miners in the industry to look more at being asset allocators to mining assets. In my view, in some ways, you can characterize investing in the space as allocating capital to an income-generating asset. Some allocators manage it more efficiently, some manage it less efficiently, and trying to select those that are managing it more efficiently, looking at them based on their price to NAV to understand whether they have what the value of that miner is or should be, whether they're mispriced in the markets. Now one of the trends that's been developing, and I wanted to ask you about, Taras, is how miners have started to adopt this and become more focused, how ancillary services has played a part, and whether you think that's a positive trend for the industry that could continue.
Yeah, I 100% think it's a positive trend, and I think it's a key characteristic of the sector maturing. I think right now the value chain needs to crystallize, and that's actually happening. You see teams like Jaime's, teams like Fred's yesterday, the CleanSpark team as well. They're pretty light when you look at the top line that they generate, and hopefully the bottom line over time as the market recovers. And really what's happening is that the ancillary services market for miners is allowing the management teams to stay FTE or full-time employee light. And the reason being is because if you're really good at generating or operating an asset, that's your value to the market, right? Ancillary services like repair, distribution, supply chain procurement, That's really what's going to be offloaded from the miners so that companies like SunnySide, which is one that I founded, can really provide those services and allow CEOs like Jaime to really do their job as best as they can, which is generating hash rate and value for investors. And so just like there's a Barrick Gold, you don't hear about 1,000 different service companies, but there are these service companies providing values to other commodity industries like gold and oil and gas, and the same thing's happening in Bitcoin mining. And that's actually a really good thing, because the value from an investment perspective can be concentrated so you're allocating risk accordingly, as you mentioned earlier.
Allocating risk, that perfectly leads to my next question. So we just talked about how, again, miners are looking at potentially being more like asset allocators, how they're investing, being operationally lighter. Now, another key component of that, if you're looking at yourself more as an asset allocator, is managing risk. And this is something that some players in the space, particularly those who kind of were the children of summer, really blundered, and where others who'd seen a few of these shows before were more patient. So Jaime, I'd love to understand your view on risk management. What are the key things that, as an investor, you should be looking at from miners in how they manage risk, how they manage risk from power perspective, how they manage risk from their balance sheet perspective?
Yeah, I mean, I think I already touched on it. I think there was a lot of FOMO. There was a lot of hype in the space. This was the first time. This last bull market was the first time we saw a serious influx of available low-cost capital. I think at our peak in the bull, there were 40 publicly traded Bitcoin miners alone, and they were taking significant amount of capital from the market. And there was, at a time when the hardware prices were at an all-time high, there was a supply chain constraint, and so people were allocating that capital to hardware that was about 5 times, 6 times the price that it was really worth. And so that I think created a big bubble that we saw burst, and now market pricing has adjusted from a hardware perspective. So people that were patient with their capital and kind of waited for the cycle to turn are in a much, much better position on the back of that. So I think when investors are looking at miners, I think it's important to do a really hard look at the fundamentals. I think that FOMO cycle caused people to kind of overlook the fundamentals, and they got caught up in the headlines. We talk about the exahash headline wars, and really what that refers to is in the bull market, if you said you were going to hit 20 exahash and you put the headline out there, you didn't necessarily need to have a funding roadmap that got there, and the market was rewarding you for those headlines. And I think we weren't doing the best job of actually analyzing the operational capabilities of the team, the balance sheet, and I see a lot more maturity now in how investors are coming into the space, how analysts are thinking about the space. Just as an example, when we first diversified into the HPC business, analysts weren't asking me any questions about that side of the business. It was really just kind of an afterthought, and I fast forward to my earnings calls now, and the analysts are very interested. They're asking a lot of questions about that business. The diversification strategy has turned into a big theme amongst miners in this bear market, and for a very good reason. So Taras and I know each other well. I love Taras. I fundamentally disagree with the asset-light model. I think that's a great model for small miners, but for somebody like us that has scale and is looking for diversification from fiat revenue flows and from prop mining, our diversified strategy is actually about bringing more things in-house so we control as much of the margin and as much of the operations of the business as possible. But I think you can only do that when you have scale, and what Taras is talking about is perfectly suited for your small, medium, even like low, large miners that should not be trying to tackle all of that on their own.
And sorry, Jaime, just to follow that up, what aspect of that is, so, there's a presentation yesterday that was highlighting, your the returns that people expect from different investments in this space, how you're allocating capital. But when you think about allocating capital to infrastructure, are you thinking about it, how much does risk then factor in? Because we've seen that, you know, the idea that that infrastructure providers were lower risk businesses seems to have been quite a fallacy. So how is you know, the risk of infrastructure a factor in when you decide to invest in infrastructure?
I think the ultimately the prices that you're paying, your cost of capital, are critical components. I'm sure we'll touch on this later, but we've recently announced a very large merger. We're merging with a U.S. company called USBTC, and one of the reasons, in particular, that we chose each other as partners is because of our diversification strategy. So my HPC business is obviously fiat-based. It doesn't have those capital risk exposures. It's a different business model, monthly recurring revenue, traditional enterprise customer base. And in the case of USBTC, they do prop mining, but they also have a significant portion of their business, which is hosting. So that takes a significant amount of capital risk off the table, as well as they've created a new category called managed infrastructure operations, which is a no CapEx model, where they go in and actually manage a third-party owned site, but they do the operations and they bring in their purpose-built software stack to actually control and manage the miners. So when I think about risk, I think about our business as it continues to grow, really as a portfolio where we're making capital allocation decisions based on where the market's going, what the cycle looks like, what the cost of capital is, what the best allocation is. Luckily, neither USBTC nor myself ever deployed capital at $100 or $120 a terahash, and we didn't have to. Because if your business is effectively diversified and you have good access to capital and credit, you can lean into the various business lines based on where the cycle is.
Sorry to stick on this, but I do want to challenge you on one point. I mean, the idea that infrastructure hosting is a lower risk business model seems to be challenged by the backdrop that some of the biggest failures were for hosting businesses. You know, I mean, the largest kind of pure play hosting provider was a catastrophic failure because the hosting and, you know, from some of the way you look at it, the idea of hosting is, you know, okay, actually we've locked in our margin, we've locked in, you know, our well, they hadn't really locked in their costs, but they think they've locked in their...
You're getting right to the answer on your own there, Zach. As some of you know, but probably not all of you, I spent 20 years in the traditional trad tech world, most of it with in infrastructure, so traditional data centers, co-location, hosting, managed services, cloud. And when I came into the Bitcoin mining space and started looking at some of those hosting models, they hadn't done the basics of kind of back-to-back contracting and risk management. So they were in many cases exposed on the power side and hadn't passed that exposure onto the customer. Sure, part of it was a mismanagement of capital and taking on too much leverage again, but it wasn't a fundamental business problem. It was a business model problem. It was an execution of the business model problem.
Okay.
And hosting is, like, obviously it's less, you're putting less CapEx at risk because you don't bring in the miners. You just have the infrastructure. And if you've crafted your contracts properly, you've got downside protection because you have embedded security on the miners that they bring into the facility.
So again, going back to risk management, this is critical, and understanding how your partners or your service providers do risk management. And I think actually for those of you who are looking for the asset-light model, who are looking to just buy machines and host them, look at your hosting provider. Look at whether they've got their contracts down correctly, because a lot of the guys that are offering you really low hosting rates, particularly when power prices are low, it's probably because they haven't actually locked in those power prices. And think about the risk that that poses to your business. If you're stuck with somebody who ultimately you don't want them to lose money. They need to make some profit. Otherwise, your miners are going to be at risk. So Pierre, I know that a big part of your work has been in helping institutions understand risk management. What are some of the things that you advise clients, allocators, institutions that are coming into the space to focus on when they're doing risk management?
Yeah, so we looked at a lot of miners over the years, and we came to a, let's say, a very comprehensive framework and due diligence framework, which, by the way, we're going to release in 2 weeks from now. But essentially, it comes down to really understanding the entire value chain of a Bitcoin miner, from contracting the energy to setting up the infrastructure to the O&M part. And last but not least, the commercialization strategy, right, which we touched upon for a while now. And across this value chain, there are several categories of risk you need to look at. There's a supply chain risk, there's a market risk, there's a technology risk, because also I think in the last summer, so to say, a lot of miners took some bets on some machines that maybe didn't promise what they were initially advertised for, to say it a bit friendly. And then there is indeed the commercialization risk. And the commercialization part can go into many different ways. It can go into a wrong mode of, just being on the extreme side of things, either be in full hodl mode or be in full divestment mode. But it also needs to take into consideration your counterparty risk in your commercialization strategy, because we saw this now that a lot of, let's say, banks were choked off the system, which means all of a sudden a few people got into trouble because they couldn't offload anymore as planned.
So Taras, you deal with a lot of the wholesale market. You've seen firsthand a lot of liquidations of assets. Yep. A lot of that has come out of an enormous amount of leverage that was taken in the space. Some of the investment banks and people from our side of the world, the financial side of the world, started looking at this space and seeing, asset-backed lending. This is a model where we can deploy capital, they thought about, these machines are trading at $40, $50, $60, so I can lend at a 50% LTV, and my assets are safe, and I can make a nice return. And a lot of those lenders have faced a lot of challenges. So would love to understand, what you think is the role of leverage going forward. As we look at, again, we're talking about the future of crypto mining. What do you think is the role of leverage going forward? Is asset-backed lending going to make a comeback, or what do you think are the lessons learned?
So I'll put my former investment bank hat back on. Jaime mentioned something really eloquently earlier that people really need to let sink in, is that teams like Hive, teams like Hut 8 that have been around for a few cycles understand that when the going is good, don't over leverage. We've also got CleanSpark here with us today. They took that example and actually learned from it. Some of the other folks in the industry that did not, they assumed all prices continue to appreciate over time, seem to have forgotten what risk management and treasury management really is about. And so, unfortunately, some of the financing teams forgot about that too. And some of their agreements were focused purely on asset allocation guarantees against only the servers that were massively overappreciated given any type of semblance of reasonability based on future cash flow delivery from that asset itself. So all I have to say is massively overvalued, and they lent against something that they shouldn't have. And at LTVs, or loan-to-value ratios, that were far too aggressive versus where the industry was at its cycle at the time. And so what's happened is we've had companies like BlockFi, which was a major financing company, basically go into insolvency. We've had companies like Celsius, which was part of that industry a little bit, also go into insolvency, not because of the mining, but because of their other risk allocation or lack of risk allocation strategies. Other companies like Anchorage, they've survived, and because they were very conservative on how they approached LTV and as well as their APRs. And so I think this is what has been necessary for the industry to continue to evolve. And while I respectfully disagree with being too much of a conglomerate and diversified company, I do think there is some benefit to having some diversification in your revenue streams. But as Jaime mentioned as well, capital markets really do care about cash flow. We really do need to start valuing companies on an EBITDA multiple basis or a price to cash flow basis, just like we do with other commodities, because at the end of the day, generating hash rate is really a commodity business. Scale will win the day, efficiency will win the day. And that's what's important for investors to be looking at when they're looking at Bitcoin mining. We're not going away. The foaming at the mouth that's happening right now at some of the levels in DC and the US, I think that'll subside over the next few years because the election cycle will pass and some of these zealots that don't look at facts objectively will likely get voted out of office. The major power companies globally like Exxon and Shell are looking at Bitcoin mining as a way to support renewable power growth. We're not chopping mountains off to support coal. It's really about intermittent power and how Bitcoin mining can be an underpinning on an economic basis away from taxpayer subsidies. And so I think that's something that is also being factored into the risk management models, is that this really is a long-term industry that is here to stay and that is maturing pretty rapidly. And again, the teams that we have here today are testament to that.
So we talked about the importance of risk management from the asset allocation side. How miners buy assets, whether they invest in infrastructure, whether not, when they buy, how they buy. But there is another important element that we've touched upon, but I'd like to kind of unpackage a little more, which is managing the other side of the balance sheet, how you manage risk and how you raise capital. And that's something that HUD 8 has done particularly well, knowing when was the time to hit the equity markets and reduce the debt, and actually kind of swimming upstream from what a lot of the other miners were doing who ended up getting into trouble, versus using debt effectively on the balance sheet. So, Jaime, what are some of the things that you look at as a CEO, as a public company, when you decide when is the time to hit the equity market, when is the time to raise debt, when is the time to hunker down?
Well, look, it's really, really hard to get everything right, and you're just doing the best you can. And I took a lot of heat last year, actually, in the peak bull market. They were saying at that time the prevailing sentiment was this was the super cycle. It was only up from here, and so that's why people were willing to pay the prices that they were. Margins were so lucrative in mining, and everybody thought it was going to Bitcoin was going to go to at least 100K, and they were throwing everything they had based on that thesis. Luckily, again, we've been around for a long time. I've got a great board, and one of the things I think we timed really, really well was we were able to do an equity raise shortly after we dual listed onto the NASDAQ. That was a significant raise. It wasn't a unit-based structure, which is very rare in this space. And then we just sat back and watched very carefully the market dynamics, and ultimately didn't deploy much of that capital into infrastructure. Instead, went and did our M&A transaction. But I was getting called too overly conservative. I didn't believe in this space, and it can be really, really difficult as a public company CEO. You're trying to do the best you can as a fiduciary, but you kind of have to take the hate when you're swimming upstream, as you so thoughtfully put it.
Yeah, and that was something that, I really hats off to Jaime. She raised an ATM. It was an ATM at the right time. And yeah, everyone was saying, "Why? Well, you're sitting on all this cash in Bitcoin. What are you doing?" And clearly, Jaime had a crystal ball somewhere, and she. I
just looked behind me. I looked at all of the past cycles and figured, until it breaks, you got to expect it to repeat.
No FOMO. So
yeah, ignore Twitter.
Exactly. Well, so yeah, it's we are a little over time, but did want to close out the discussion with potentially, a couple more points that Pierre and Taras might recommend to people that are looking to invest in the space, whether it's too late to come into mining as a new player, whether you should be investing in the existing players, given the institutionalization that space has happened, and again, compounding my question with the...
At least you're catching yourself now.
The scale problem is do you have to, if you are going to come into the space new, can you still come in small, or do you really have to go in big?
Yeah, I go first, thanks. So I think it's not too late to go into the space, because I think what we're going to see is we're going to see a lot of institutionalization of blue chip companies or sovereign funds going into the space, offering new investment opportunities that most likely are pegged to more long-term power contracts as well, which de-risks a few elements significantly. Second point I want to make is that even though it's not going to be anywhere near the scale of centralized big mining facilities, we're going to see a renaissance of decentral mining in combination with circular systems. In Germany, you already have some really nice applications where the heat of the miners is used for heating the office. We have some applications in the Middle East where the heat of the miners is used for bottled water production. So I think we're going to see a lot of that as well.
Yeah, I mean, I think that if you're thinking of setting up a miner for home mining, you're probably not going to hit an ROI that you're anticipating. I think that if you're interested in participating in securing the Bitcoin network and heating your pool, for example, or your house through using a Bitcoin miner for the BTUs, that could be an interesting value proposition. If you're looking at it as an investment thesis, I would recommend that you either work with a power provider or an infrastructure provider to get to scale rapidly, because the efficiencies are absolutely needed. When you're competing against teams like we have here today on generating hash rate and trying to win your portion of the next block, it's very difficult, especially if you're not at scale. If you're looking at an investment allocation perspective, do your research, identify the top 5 public companies that you're interested in, and do a split across that. Not investment advice, but that's how I would be looking at risk or allocation of capital on an individual basis. If you do have an interesting power project with very competitive costing, there could be something there. And that's one of the things that I work on with different entities, family offices, sovereign wealth funds as well, is to help them identify, does it make sense? Is the NPV positive at the end of the day? Because ultimately as an investor, that's what you're looking at. So the answer is yes, it's still a great time to get in, actually, especially in the public markets, given how compressed the valuations are still.
Well, I'll have to close out. I would love to continue the discussion. As all of you know, we're all very passionate about the space. Actually, just since it was mentioned about using heat for other uses, I see 2 other friends in the audience who've done some quite innovative and interesting things in the space. Frank Holmes has been using it for greenhouses and to help grow food. And our friend Kjetil from Norway has been using heat from their data centers to dry wood for local furniture makers and for the local community in a place where drying wood in the winter is almost impossible. What takes a few months for a furniture maker takes a few hours at a Bitcoin mining data center. So I have seen a lot more interesting use cases for off-taking all the heat and excess that miners generate. But a pleasure to have this panel. Thank you so much for joining us. I hope that this was helpful for you as you think about how you might consider investing in the space, how you allocate, how you do risk management. I really would suggest more than anything, do your diligence, do your homework. Don't just buy the miner that everybody's buying. Don't just follow the FOMO. You really do your homework, and sometimes it will feel like you're going against the stream. More often than not, actually, you might feel that you're going against the stream, but in the long term, those are the strategies that have played out when you really do your homework and stick to your guns. So thank you so much for having this discussion with us.
Thanks, Zach.
Thanks.